Good day everyone, my name is Tivya Shalini and these are my group members which consist of myself, Lai Wunji, Murtado Muhammad Tore Akbar, Hee Jin Long and Tan Pei Peng. Today, we are presenting for Credit Risk Management group presentation for session A202. So moving on to introduction, for your information, we have chosen 5 banks from Singapore for our study. So first bank is UOB Bank. So in Singapore, UOB Bank is a market manager in the Visa and Private Home Advancement affiliations. So it is comparatively a central part in credits to almost nothing and medium and divorce. As for DBS Bank, it is a Singapore-based multinational banking and financial services company which was headquartered in Marina Bay, Singapore. So it has been established on 16 July of 1968 by the government of Singapore to replace Economic Development Board's industrial financing operations. As for OCBC Bank, it is one of the well-known multinational banking and financial corporation that headquartered in Singapore. It is also known as one of the most oldest banks in Singapore. So OCBC Bank is the merger of 3 local banks as well, and it has over 570 branches and executive department in 18 countries. So moving on to Citibank. Citibank Singapore Limited was incorporated in Singapore on September 24, 2003. So it operates a business unit called Citi Business Singapore that caters to small and medium-sized enterprises, which are also known as SMEs. As for HSBC, it plays a pivotal role in Singapore's financial services industry, satisfying multinational companies, local enterprises, private banking customers, institutions and retail customer banking needs. So HSBC service terminals are at 3 locations on the island, and it is also the actions taken by HSBCs is a less risky proposal, that is, they hold on to more deposits than loans, and the ratio of loans to deposits is 90%.
Hi everyone, my name is Lai Wunji, matric number 262258. Now I will briefly explain the literature review of the credit risk. According to the Marozo and Mutezzo, credit risk is the possibility that may cause shakiness of bank and endanger the endurance of financial institution. Shakiness of bank means that the bank is not stable and may cause trouble in lending management. Endanger the endurance means that the credit risk will threaten the sustainability of banking industry and cause them cannot survive in the long term. So the measurement of the credit risk is using NPL ratio. The formula is non-performing loans divided by total loans. As the researcher Gaizot, Kapiti and Savaraj explained that the higher the NPL ratio indicates that the bank has a poor executive in managing their financial resources, and then cause the credit risk becoming higher.
Hello, my name is Muhammad Murtado, metric number 26835, and I'm going to explain how we did the methodology in this report. So, in this report, the first step is we gather all of the required internal bank-specific variables of 5 banks, which is UOB, DBS, Citibank Singapore Limited, SSBC, and OCBC, through combining all of the financial reports and financial statements of the year 2015 and 2019. And we also find another data, which is the macroeconomic variables, through various sources. And then the second step is we analyze all of the data into 2 models. The first model is only the internal bank specific variables, how those internal bank specific variables of those 5 banks influence the credit risk of those 5 banks. And then the second model, which is macroeconomic variables, is how macroeconomic variables affect the credit risk of those 5 banks. And then the third one is a combined analysis, which is we put the internal bank specific variables and also the macroeconomic variables and to see how they related to the credit risk of those 5 banks.
I will explain the trend analysis of the 5 banks among the 5 years. First, we look at the credit risk. The graph shows that HSBC Bank has a fluctuated trend in credit risk, and the others has a stable trend in credit risk among the 5 years. HSBC Bank gained the highest percentage of credit risk, which is 39.88% in 2016, whereas Citibank gains the lowest percentage of credit risk, which is only 0.32% in 2018. There are 4 independent variables which are significant to influence the credit risk of the 5 banks. The first variable is regulatory capital. The graph shows that HSBC Bank has a slightly fluctuated in regulatory capital, and the others have the stable trend in regulatory capital among the 5 years. From the graph, HSBC gained the highest value of regulatory capital, which is 4.2 in 2017, whereas UOB gained the lowest value of regulatory capital and also maintained the same value of 0.01% from 2015 to 2019. The second variable is financial loss provision. Same as the previous graph, HSBC Banks also shows a slightly fluctuation in financial loss provision, and the others shows a stable trend in finance loss provision among the 5 years. HSBC Banks gained the highest value of financial loss provision, which is 1.6702 in 2016, whereas OCBC Banks only gains the lowest value of finance loss provision, which is 0.10% in 2018. The third variable is finance. The graph shows that all of the banks have stable trend in finance among the 5 years. From the graph, UOB banks gain the highest value of finance, which is 0.7980 in 2018, whereas HSBC Bank gains the lowest value of the finance, which is 0.1479 in 2015. The last variable is liquidity ratio. The graph shows that HSBC Bank has a slightly fluctuation in liquidity ratio, and the others still shows the stable trend in liquidity ratio among the 5 years. HSBC Bank has the highest value of liquidity ratio, which is 4.9056 in 2016, whereas DBS Bank has the lowest value of liquidity ratio, which is only 0.1027 in the same years. So in overall, these 4 independent variables will cause a serious impact to the HSBC Bank because it has the highest value of the credit risk and also has a non-stable trend in these all variables among the 5 years. That's all from me. Thank you.
Now, I'll talk about findings and analysis of Model 1. So as for Model 1 descriptive statistics, the first model contains one dependent variable and 13 independent internal factors variable. So the mean range was between 0.05 to 21.25. Standard deviation was between 0.05 to 14.53. And as for Model 1 correlation, so based on the table of correlations, the significant levels for internal factors for regulatory capital, financial loss provisions, risk-weighted asset, liquidity ratio, and management ratio, and as well as return on assets ratio are greater than 0.1. So this explains that the factors had positive relationship with credit risk, but the correlations are not significant. This is due to them being more than 0.1. As for loan size, its value is below 0.1 at 0.029, and it is significant to credit risk. This means it can influence the credit risk. So based also on the table of correlations, the significant levels of other variables such as leverage, risky sector finance, finance ratio, debt to equity ratio, equity multiplier ratio, and debt to assets ratio are lesser than 0.1. So what I can say from this is that this explained that the internal factors had the negative relationship with credit risk, but the correlations are not significant to credit risk. Hence, the study can decide that these internal factors will not influence the credit risk. As for Model 1 coefficients, based on the table of coefficients, regulatory capital, financial loss provisions, finance and liquidity have significant coefficients. So they have significant values which are less than 0.1. Hence, they can influence credit risk compared to other internal factors. As for ANOVA, the predictors here were the internal variables in the study, and the dependent variable was credit risk, and it shows a very significant value with 0.000, which is less than 0.1. And as for model summary, the adjusted R-square shows 92.5%, which means we have a high chance of predicting credit risk with the variables used. And it has a Durbin-Watson value of 1.863, which is in between 1.5 to 3, which is considered to be good. That's all from me. I'll pass it to my friend. Thank you.
Good day to everyone. My name is Tan Pepeng, matric number 261366. Next, I will start with the model 2 for external factor. This model also contains the result of discrete statistics, correlations, bonus summary, ANOVA, and coefficients. First, the discrete statistics contain the mean and standard deviation for dependent and independent variance. Next, we can analyze the relationship between the dependent and independent variance with correlations. The independent variant, they have a positive values of correlations, which mean that they have a positive relationship with the dependent variable, while the negative values of correlations is the negative relationship with the dependent variance. The independent variance of GDP, interest rate, exchange rate, yield curve, and employment rate have a positive relationship with the credit risk, while the less or independent variance have a negative relationship with the credit risk. However, these independent variants are not significant influence the credit risk because the significant values of these independent variants are greater than 0.01. Next, from the result of model summary, the R-square values of this model is 0.04, which means that this predictor of employment rate, GDP, output gap, and exchange rate are not fixed to this model, as only 4% of this predictor can explain in credit risk. Besides that, the p-values of this predictor that shown in ANOVA is 0.931, which is greater than 0.01. This implements that these external variants are the weakest external variants to explain the credit risk. Lastly, the coefficients contain the GDP, exchange rate, output gap, and employment rate. This model has a significant value that greater than 0.01. This means that these external factors are not influence the credit risk of the 5 banks. Next, I will pass my part to my next woman.
Okay, for the model 3 result, which is the internal bank specific variables and macroeconomic variable combined, the ANOVA suggests that 17 variables listed here have the possibility to relate to influence the credit risk of those 5 banks. And then from the correlation analysis, the variables that were positively related to credit risk, there are 12 variables, but among those 12 variables, 4 of them, which is regulatory capital, financial loss provision, liquid, and return on asset, all have significantly positive correlation to credit risk. So this means that by increasing tier 1 capital, financial loss provision, short-term market securities, return on asset, all contribute to increase the credit risk of UOB, DBS, Citibank Singapore, HSBC, and OCBC. Meanwhile, if we look at the negative correlation, the credit risk of the 5 banks that we analyzed, which is UOB, DBS, Citibank Singapore Limited, HSBC, and OCBC, will be mitigated if we increase the amount of total finance to total asset, total liability to total equity, total asset to share capital, and total liabilities to total asset. So this is really interesting.
Lastly, I will continue with the path of discussions and conclusions. The result of correlations show that Model 1 and Model 3 affect the output of 5 banks in Singapore. Model summary, ANOVA coefficients for 3 models have been presented in this study. The output of UOB Bank is mainly affected by the 2 models, which are Model 1 and Model 3. However, this study had some limitations. First, is the bank that used as the sample is only 5 banks from Singapore. And the annual report also only 5 years from 2015 to 2019. Lastly, due to the time limit, we only collected a restricted amount of data for the analysis of SPSS. The recommendation to this study is the future research are suggested to collect more banks to compare the findings so that they can increase the number of observations, years, factor, and the sample of bank. Therefore, they can gain the significant result to explain the dependent variance. In conclusion, the issues of population credit risk must be paid attention by UOB, DBS, OCBC, Citibank, and HSBC Bank in Singapore. The credit risk must be managed widely by board and shareholder to reduce the credit risk. This is because the higher credit risk may increase the other risk and also the risk of bankruptcy to the bank. Our presentation is end here, and thank you for your attention to watch our video. Thank you.